All right. Well, let's get going. So thank you everybody for attending today's webinar on this concept that we call becoming your own banker. A couple of housekeeping issues before we get started. If you have any questions or you have any comments on your Zoom app, you should see a Q&A box. So feel free to click on the Q&A, tab your questions. One of my colleagues, Shirley Albert, is our second panelist tonight. She's gonna keep checking the Q&A. So Shadi, feel free to jump in if we see any questions coming in. I'll do my best to answer those. As I go to the presentation, if anything comes up, again, please feel free to put the Q&A there. Also, if you would like to have a follow-up discussion with you individually, my email and my team's email should be getting to you via email. So you can contact us if you have additional questions that you'd like to go over. I can see that we have some existing clients in attendance and some prospective clients. So if there are any additional questions or concerns, feel free to reach out to us. We can always do a one-on-one session. At the end of the webinar, you will be receiving an email with a survey, a short survey, just asking you how we did and if the information was clear. And if there's something that you would like to give us as feedback, we will really, really appreciate. We are starting this series of webinars in an effort to coach our clients better and give them the information they need to make good decisions. So any feedback that you can give us will be greatly appreciated. All right, so with all the housekeeping issues out of the way, let's get started tonight with becoming your own banker. So I'm gonna do my best in trying to kind of position this concept where it actually fits. A lot of you, I'm sure, have seen videos in social media, on TikTok or whatever, about banking or infinite banking and all these different kind of names that are out there. Unfortunately, most people are doing it wrong. And you'll see kind of what I mean as I go through this. So I'm gonna try to cover what becoming your own banker is, but also what is not. Right? So you have a very clear idea as to where this fits, why it's such a great concept that we believe people should be using, something that I personally, myself, I use in my personal finance, and I'm happy to share that with some of you if you guys want to learn more about how I use it. But bottom line is my goal is to share it with you what it's all about and also a little bit of what it's not, so you have a clear idea of what it fits in your financial life. So talking a little bit about QX Financial, as I go into the banking concept, we like to do things a little bit different. So I tell people banking is not a product. Banking is not something you buy. Banking is a process. It's a way of doing things. But it has to have a purpose. There has to be a reason behind why you want to use it. So one of the things that we like to do with our clients is first is we got to identify what are you looking for? What are your goals? What's important to you? Most people do not want money for the sake of money. They want money because it's a bridge to somewhere else. They want financial independence because it's going to allow them to do something else in their lives besides just working and trying to make an income. So we have found as financial planners and advisors that if we work with people in identifying their goals and their whys, it makes sense for them to make the effort to learn and to apply new concepts and new ideas, such as becoming your own banker. So if you haven't worked with any of our advisors or you have an extended advisor, make sure that your reasons as to why you want to be efficient with money is understood really well by your advisor. Once we identify your goals, we want to look at maximize your efficiency. There's many ways to get to where you want to go. Right? There's many ways that we can do that. But what is the most effective and efficient way? I don't know about you guys, but I have limited resources. My clients have limited resources. We cannot afford to be inefficient. And that's where the banking concept comes into play. It's a very efficient way to develop wealth over the long term and to prevent wealth transfers to other people, which we're going to talk about in a moment. So we talk about banking because efficiency is extremely important to achieve financial success. And lastly, our ultimate goal is to build wealth. And I use that word carefully because we like to build wealth in the context of what that means to you, right? Building wealth doesn't necessarily just means accumulating money or having a greater rate of return. Building wealth means different things for different people. So we have to understand what that meaning is for you and then use the concepts and strategies that will get you there. I guess what I'm trying to tell you is that just a better return or just a hot market doesn't necessarily mean financial independence and success, and definitely doesn't mean necessarily building wealth the way you want to. So these three things combined are key for us. And that's the reason we talk about the banking concept. But let me put things into context, because I'm sure some of you that are here today have worked with financial advisors before. I know we have some clients on the webinar, but also some people that are looking to potentially work with us. And again, I'm sure you work with other people. And when it comes to the financial planning world, most of us as financial advisors have focused historically in two main areas of wealth creation. One area that we call saving, in a second area that we call investing. Both of them very, very important. Both of them should be part of your financial plan. But there is a third area of wealth creation that almost never gets discussed, and it is as important, if not more, than saving and investing. And that's the area that we call banking. Banking understood not like your local commercial bank per se, but banking understood as the process of multiplication of money, of having money being able to do different things at the same time. You see, the way most people understand money is as a one-way street. That's the way I like to call it, right? If I'm saving my money, well, I can't really spend it, because if I do, it stops being savings, right? Or if I'm investing my money, I will have to wait for that investment to mature before I do something else with the money. And again, we think of money in that way, but money is not physical only anymore. And money can have multiple permutations and can do different things at the same time. So that process of multiplication of money, of having money do different things at the same time, we call that banking. And this one-way street phenomena that I call, the technical name for that is opportunity cost. Because I'm doing one thing, I'm not doing another. And really what we want to do is to be able to do multiple things at the same time. So an example that I always like to use about opportunity cost is the idea of, buying some coffee, right? So let's say you get together with your friends, you go down the street, you're gonna buy a cup of coffee, right? This guy right here. From a purely financial perspective, the true cost of that transaction is not just a cup of coffee or the $5. Is the $5 plus any interest you could have earned on those $5 if you would have been able to keep the money with you for the rest of your life, right? So when we use money as a one-way street, there's always a cost, an opportunity cost. So in the terms of the coffee example, yeah, you're getting a coffee in return, but all the future equity that money could have earned you for the rest of your days, that money is gone, and it's gone forever. You're giving up something today, you're giving up something in the future in order to get something today. So the point that I'm trying to make with this is, what about if there was a way where I can spend my money when I need to, but yet remain able to earn equity on that money for the rest of my life? Wouldn't that be a much better financial approach to my spending and my budget? And the answer will be yes, right? And that's the process that we call banking, because that multiplication effect, that multiplier effect, it's exactly what banks do. So we're not going to create your bank like a Bank of America branch, right? That's not what I mean. We're talking about the mechanism, right? Not the institution, but the mechanism, the financial mechanism that banks use to multiply and create a multiplier effect. You want to be able to do that yourself. So before I go into how is that possible and how banks work and how we can set that for you, let me make a separate point, which is what I like to call your circle of wealth. So to everybody on the call today, I would like you to imagine all the money that you have earned in your life up to this point, right? Think about when you were a teenager, you work at a local restaurant, or you had a paper route or whatever it was. And now, think about all that money. And then you got your first job in your 20s, and then you got a real job when you're late 20s, and so on and so on. Think about all the money that you earn, that you spend, and ask yourself this question: am I still making interest on that money that I spent 20, 30 years ago? And I think you'll agree with me that the answer is no. That money is gone. That money is gone forever, right? So now let's imagine all the money that you're going to earn in the future. Do you want the same thing to happen to that? So I think of all the money that you've earned in the past, and all the money that you will earn in the future, and let's put all that money inside the circle that I call the circle of wealth. That's what this represents. I have this kind of like tongue-in-cheek joke that I have with my clients that I tell them that everybody's going to be a millionaire. And they're like, well, what are you talking about? Well, if you make at least the average income in the US today and you work for the next 30 years, you will earn over $2 million. So you will be a millionaire. Now, the problem is that we don't have all the money working for us, right? We earn it and it goes away. And that's what happens to the average American. As a matter of fact, the average American today spends about 30 or 35% of every single dollar that he or she earns in taxes. And I'm talking about all the taxes. A lot of you that are in the call, I'm sure you guys have jobs. So you know that 15.2% of every dollar you earn before you get out of the job is already gone, right? That's your FICA, that's your Medicare, that's your Social Security. Before you get back in your car and go home, that money's gone. And then on top of that, you gotta pay your federal income tax. I live in the state of California, so we do have a state income tax that we gotta deal with. And then every time you buy something, you gotta pay a sales tax, right? And then if you own a home and you have that privilege, now you gotta pay a property tax, and so on and so on and so on. So when you look at the per capita cost of all those taxes, that's how you get to that 30-35% of every single dollar earned. Now, obviously, we live in a society where we have to pay taxes. We need to have the firefighters show up when we need them. We need the cops. We need services, right? So I'm not advocating to avoid paying taxes. My point is a little different. The point is, what is the rate of return? And this is what I ask my clients. What is the rate of return that you're making on all the dollars that you're using to pay for those taxes? And obviously, the answer is zero. Once the money leaves you, it's gone forever. It's a wealth transfer. You're taking money that you're earning through your skill and work and passing it somewhere else. As valid as that might be, it still is a wealth transfer, right? Similarly, the average American is going to spend another 25 to 30% of every single dollar that we earn servicing debt. Servicing debt. That's your mortgage, that's your credit card, your student loans, your personal loans, and so on and so on and so on. And I ask my clients the same question. What is the rate of return that you're making on all the dollars you're using to pay down that debt? And again, the answer is zero, right? Once the money leaves you, it's gone forever. It's another wealth transfer. So the last 30 and 35% of our total income, that's lifestyle. That's paying for rents, that's going to Disneyland, that's, vacation, whatever. Everything that we do every day. And just like with the coffee example, it's another wealth transfer, right? Because you pay the bills, you transfer money, and nothing is coming back. So for the average American, a lot of money that they earn goes away before they can even take advantage of it. So traditional financial planning tells us that what we need to do as individuals is take 15 or 20% of that extra money that is left over and put that money somewhere else. Savings, retirement, paying for college, buy a car, buy a home, get married. That's a lot of pressure for very little money. We have to do a lot with a very small portion of our income. But the idea is that we take this money and we invest it somewhere, retirement accounts, the market, whatever, and the return of those investments allows to finance all the things that I just mentioned. Let's be real. Does that sound like something plausible? Does that sound like that's what the average American is doing? And obviously the answer is no. It's not possible. The savings rate in the US today is less than 5%. The average person right now cannot afford to save 20, 25, or 30% of their income, which is, by the way, the mathematical amount that is required to be put away to have successful retirement. It's impossible. So what is my point with all of this? Well, what about if there was a way where we can take, let's say, 10% from the tax dollars that we're giving away, maybe another 10% from the debt area, and what about if we can put this money back to work for our clients? If I can take that 20% and put it back on your pocket, wouldn't you say that I just made you 20% on your money? And that will be correct, right? So the question then becomes, okay, Janko, that sounds great, but I need to pay my taxes. I cannot avoid that. I need to, buy a car and have debt because, we got to do stuff. I got to use my credit card. So how do you recover that money? How do you recover that 20% from my budget? Through this process that we call banking. That's how we do it. So the financial principle that I would like to leave you with from this slide is what it says right here. There is more money in not losing money than in making money. There is more money in preventing the wealth transfer to begin with than to try to overcome that transfer through investments alone. In other words, the way we think of money is in terms of boxes, right? That's how we compartmentalize everything in our brains, because that's the way our brain works, right? This is my saving money. This is my retirement money. This is my play money. No, there is no money. There's no boxes. That's accounting, non-economics. There's only one circle of wealth. However you slice and dice it, that's accounting. The reality is that if we can prevent the wealth transfer to begin with and put that money back to work for you and compound over time, that will be better than giving it away. Yet, we need to spend it. So how can we do both things at the same time? Well, once again, we do it through this process that we call banking. So the solution to this problem is we got to understand capitalism not just as a means of an economic organization, but we got to take the word capital and understand that in a capitalist society like ours, the only way to be successful is through the accumulation and preservation of capital. That's the way it works. And that's why I put this sentence right here. The only true path to wealth creation is capital accumulation. There is no other way. We've been sold this idea that if I borrow, leverage, I'm going to get to financial success. It works until it doesn't. As we say in the investment business, trees do not grow to the sky. There is a limit of what you can do. But if we focus, on the other hand, on the accumulation and conservation of capital, it is a different conversation. And that's what the banking concept is all about. So let's talk about banks for a second. Let's explain how this plays out. Some of you may have heard of this concept called fractional banking. And simply what fractional banking means is that every time you deposit money in your checking account, literally that money gets multiplied 9 to 12 times by banks and lent to other people. Literally just like that, right? So this is not a class on economics or fractional banking, but all I would like you to remember is that one bank's liability is another bank's asset. That's it, right? And then that asset becomes a liability again, and then a debit for another bank, and so on and so on. And that's how $1 gets multiplied multiple times, right? So if you want to go deeper into that and how that works, I'm happy to explain that on a one-on-one basis. But that's the basis of the financial system that we live under. So where does that money go? Well, that money gets multiplied, and then it goes into mortgages, credit cards, personal loans, student loans, auto loans, business loans, and so on and so on and so on. And then what happens is the people that receive these funds, for the most part, will pay the bank back both principal and interest over time. So you should know that your local commercial bank makes anywhere between 24 and 32% on every dollar you deposit, and then they turn around and pay you 0.01% of your checking account. That's an awesome deal, right? I mean, for the bank. I'm not hitting on banks. I'm saying it's a great business model. If I can take money from you at 20 or 30% and then lend it to somebody else at 30, that's an awesome business model, right? But it's not awesome for you, because what that means is that as you have all this cash, or as you do these wealth transfers, you're leaving money on the table. So the principle of becoming your own banker is, what about if you become the bank? What about if you are the center of your financial structure? So you are the one that finances your boat. You are the one that finances your retirement. You are the ones that finance your next vehicle instead of a financial institution. And by doing so, you are the ones that receive the rewards instead of a third party. That's the core concept of the becoming your own banker concept, that you become the center of your financial life, right? Let me give you a quick example of this. Let's say that you have $10,000 on a checking account. That will be an asset for you, right? It is your money, it's in your checking account, you can do whatever you want with it. Let's say that you got a car loan and you're paying $300-400 a month. Like in my example right here, you have a car loan like I draw right here at the bottom, right? And you're paying $300 to $400 every month to a financial institution. That will be a liability for you. You're transferring money to somebody else. Wealth transfer, like I said earlier. For the bank, it is a different accounting. For the bank, your deposit is actually a liability because you can come in and claim a deposit, at least theoretically, anytime you want to, right? That's why it's called fractional, because banks don't have every single dollar that is deposited ready to go. I mean, if you and I show up to the bank, they'll have it. But if all of us show up at the same time, they won't, right? We call that a bank run. So the concept here is that your deposit is an asset for you, but for the bank, it's a liability. But what about the car loan that they sold you? The car loan they sold you is an asset for them in their balance sheet. Why? Because it's paying them an income. So what I'm trying to tell you here is, what about if there was a way where we can take all these liabilities that all of us have and turn them into income generating assets for you, just like banks do? What about if your rent made you money? What about if your car payment made you money, and your student loan and your retirement dollars made you money, and the wedding and all these things that we had to buy over time, over our lifetimes? What about if those were assets instead of liabilities? That will be a much better financial position, wouldn't you say? That's the whole point of becoming your own banker, to remove the third parties, and all that interest, all that principal that goes somewhere else actually accumulates for your benefit. That's the way that works. Now, usually at this point, the feedback that I get from clients is, well, Janko, all this sounds great and dandy, but I don't have debt. I don't owe anybody any money. I pay for everything cash. I'm good. Well, actually, no. Another principle that we have to understand is that everything that you do is finance. And sometimes the client pushes back and says, well, no, you're not hearing me, Janko. I don't have any debt. And I say, yes, I'm hearing you right, but you're still financing it. You're not financing it with banks' money, but you're financing it with your labor. What that means is that you have to go work to earn the money. And you already agreed with me earlier that for every dollar that you earn, look at all the money that you're leaving behind right here. I'm sorry, I'm trying to draw and it's not letting me draw, right? We already agree that before you get back in your car, you're losing all that money. So you are financing it. Doesn't feel like it, doesn't sound like it, but mathematically you are. So the point that I make here is that there is no difference between the saver and the debtor. They are the same person. So what the debtor does is they borrow money first. Oh, let me get back to my pen here. The debtor is going to borrow money first and then pay back over time and get back to zero. Well, the saver is going to save it first and then go out and buy that thing cash, whatever it is, and then go back to zero. And then now the saver needs a new refrigerator. They're going to go save, and then go down to zero. And the debtor is going to borrow first, pay back with interest, and go back to zero. So you see, there are two sides of the same coin. They both have the same problem, which is they're not building any equity on those dollars. All these dollars that you see right here that are being spent and transferred away are providing the consumer with no equity whatsoever. None of them are compounding. And I would like you to think about your own budget right now. You don't have to say anything in the comments. Just think about it yourself. How much money am I transferring every month? My car payment, my wife's car payment, the credit card payment, the boat, the RV, blah, blah. How much money are you putting away? And then do me a favor. Take that monthly amount, put it at 5% over 30 years and tell me how much money it is. And I'll tell you right now, it's millions of dollars. We don't realize that these wealth transfers over time is not just what we're paying, it's also what we're not earning. And the amount is in the millions of dollars. And I'm going to show you an example of that in a moment. So let's talk about buying a car, okay? And the reason why I like the car example is because most of us understand a car, right? But it doesn't have to be a car. This is anything that you do with money, right? So there's three ways to buy a car. You can lease it, you can finance it, you can buy in cash, right? For my example, is buy the car cash because once again, we don't want to pay interest if we finance it. We don't want to pay a factor if we lease it. So let's talk about just buying it in cash. Let's see what happens, right? So what the average person will do if they want to buy the car cash is they're going to have to save it first. So they're going to open a savings account, a checking account, put money there every month. until they have enough to buy the car. So let's say that you put away $50,000. You like this vehicle right here, you're gonna pay 30. So you literally walk into the dealership, you write a check, here's my check for 30,000, boom, you're driving your car. Well, what that means is now there's only $20,000 in your savings account, right? Because you had 50, you pay 30 for the car, now you have 20. That's what you have left over. So the question that I ask people is, let's say that the account, most accounts are not making this, but let's say that your account was making 5% every year. Are you making 5% of 20,000 now, or will you be making 20% of 50,000? Well, naturally, it will be 25% of 20,000, right? Because you already bought the car. So the difference of earnings between the 50 and the 20 is opportunity cost, isn't it? You are giving up the 5% on the 30,000 because you had to buy the car. Now project that over 10, 15, 20 years is serious money. So what we are suggesting is that we're going to do the same thing. We got to save the money. We're going to go buy the car because we have to drive, we have to go to work, right? But next time you earn interest, it won't be on the 20. It will be on the 50. We're closing that opportunity cost gap, right? It's a much better deal. But it doesn't end there. You and I recognize that 3, 4, 5 years from now, you will have to replace that vehicle. So you will still have a car payment, both principal and interest. But that money, instead of going to the financial institution, now is going to be added to your own bank, to your own principal, compounding every year as long as you're alive. So what is the end result of this? That 5, 6 years from now, when you need a new car, you're going to have even more dollars for the next transaction, and then more dollars after that, and compounded, and so on and so on and so on. And I'm going to give you an example of that in a moment. So we're going to get to actual numbers. I'm just trying to get you guys to see the concept, right? So we want all the money working for you instead of working for somebody else. So to wrap this up, this example up, what most people do is they pay money to lose money because the car depreciates in value. Instead of doing that, I want you to drive the car and have the lifestyle that you want to have, but still make money on those very dollars. That is the key core concept of becoming your own banker. It's not an investment. It's not a get rich quick kind of situation. It's not a TikTok, what would I call it? In vogue, or just right now the thing to talk about. It's a financial position. It's an accounting process. It's a way to manage your financial affairs. That's really what it is. It's a system that we're going to teach you how to use. So in summary, before we go into the actual example, by capturing the dollars that we use every day for all kinds of things and putting that money back to work for you, you retain liquidity, use, and control of those dollars, and that will help you build true wealth down the road and complete financial independence. Sherry, do we have any questions at this point? Attendees, any questions up to this point before I go into part 2 and we complete the example of today? Any questions so far? Sorry, I gotta move my windows.
I haven't received any in the chat.
No questions yet. Okay, thank you, Shirley. Hopefully, I'm being clear, so there's no need to have additional questions. But if you do, feel free to put in the chat. It will help everybody if you have any questions. All right, so let's wrap this up. I know it's late for a lot of you. Let's get to the end of this. Let me show you a real example, okay? So I'm gonna skip a lot of the slides because we already covered these concepts today with you. Opportunity cost, we cover that. Wealth transfer, fractional banking. Those are the key concepts that we covered with you today. So let me show you a real example. And I'm gonna use a real client of ours buying a car. Once again, we're gonna buy a car just because it's easy to understand, but this can be a refrigerator, it can be your next vacation, it can be college for kids, it can be anything that you pay with dollars, right? But in this case, we're gonna use a car. So when you wanna build your own bank, the first step is what we call the capitalization phase. Just like in my previous example, when we put together the money, we gotta put together the money, right? That you're gonna use to start financing the things that you buy every day. So once again, this is not a get rich quick tomorrow deal. This is not a deal. It's a financial positioning. And like anything else, it takes time. How much time is gonna be different from client to client. Some clients already have assets and they can start banking within 30 days. Some clients need to build their assets and it takes them a year or two or longer. It doesn't matter how long it takes, as long as we do it right, because you're gonna get all back plus some. So it makes sense to build it. In this example, this client is gonna put $1,000 a month every year for the next 7 years. But that's just one example. You can, like I said, you can do it whichever way you want. You can put a lump sum, you can save every month, you can save every quarter. It doesn't matter how you do it. The principle is what matters. But in this case, that's what I'm going to show you. So when we dive into the numbers, I would like you to see right here, this is year 7. And that's the last year that my client is going to put money into her own bank. So $12,000, $1,000 a month for 7 years, that equals $84,000, right? This is the number that I would like you to remember from my example. That's the money, the capital that she put in her account. From that point on, she's not going to put any additional capital into it. She's only going to pay herself back, and that's it. All right. So I would like you to see here, I would like you to focus on these 2 columns right here, the gross cash value column and the net cash value column. And you'll see that both numbers right here are identical. So she put in $84,000 into the account. She has equity of about $79,000. And I'll get as to why in a little bit. But that's what she can access to. That's what she can use. And now she needs to buy a car. And you see that right here. She's going to take out $47,000 out to buy that car. And because she took that $47,000 out to buy the car, now her net account is equal to $43,000. But do you notice how the gross cash value column is actually $92,000? We're going to pay her interest and dividends not on 43, but on 92. Is that cool or cool? Even though she's taking out $47,000 to go buy her car, and right now physically she's driving that car, we're still going to pay her interest on her whole principal that she has put in so far plus interest. Compound over compound. That's kind of cool, right? But here's what I get the next question usually. How is that possible, Janko? That doesn't make sense to me at all. If I have 92,000 and I'm taking 47,000, how can you pay me interest on the full amount if the money is not there anymore? Well, the reason is because the money is actually there. You see, this $47,000 is not her money. This money is the insurance company's money. You get that? We're not using her money. We're using the life insurance company's money. So you see, the way most people understand life insurance is a bill. It's an annoying thing that you need to pay or you have to pay because if you die, somebody will get some money. And most people think of insurance that way, and that's why most people don't like it. That's why I never liked it until I understood the following concept. But that's not the way the IRS understands life insurance. From the government's perspective, life insurance is the income that you're unable to earn if you were to die too soon. It's not a bill. It's not money that your kids get if you die. It's replacing income you were not able to earn. And according to the IRS, that income is an asset. So you see right here, this $1.56 million that she has in there, again, in the eyes of the government, is an asset. And like an asset, you can sell it, you can leverage it, you can do whatever you want with it. Think about that $1.5 million life insurance contract as a piece of property. She can use that and leverage it in whichever way she wants to. So the reason why the insurance company is going to let you use their money is not because they're nice. It's not because they're a charitable organization. That's not why. The reason why they will give her the $47,000 is because she's posting collateral. And the collateral is right here. You see, she has $1.562 million, but if she dies right there, her family doesn't get that. Her family gets $1,513,000. Why? Because she owes the insurance company the $47,000. Now, why is this so cool for us? Because now she's leveraging on money that she will never see, because she will have to be dead to see it. Therefore, allowing her actual money to stay in the account and continue to compound and multiply the effect of the money just like banks do. So once again, we're not creating an actual bank, but we're partnering with an insurance company to mimic the same effect of having money being able to do multiple things at the same time. She's driving her car, she's earning interest, she's protecting herself, and also, by the way, she has a car payment. You see that? The difference is that that car payment, instead of going back to Toyota, is going back to her. That's where that money is going. You see right here, this is another question that clients ask me, well, Django, is this money going back to the insurance company? No, it's not. It's going back to her, which is what it should be. So now she's making money on her principal payments. She's making money on her interest payments. She's making money on the interest the principal is making inside the insurance account, right? And she has all the perks and all the benefits of what I'm talking about. Now, what happens when she needs another car? Now she's gonna have 5 years later, she's gonna get rid of the old car and she's gonna buy a new car. Check this out. Now we're paying her interest on $170,000. So let me ask you a question, and this is not hyperbole, but let me ask you a question. When was the last time that you bought a car and your account actually went up? Because she started with 79,000, she bought 2 cars, and she's still making interest on 170,000. Kind of cool, right? Now she only has equity for 86,000 because we took it out, but even her equity continues to go up. And she's gonna be doing that every year for the next, every 5-6 years for the next 30 to 40 years. Let me get to the end of this. Let's fast forward. So she borrowed her last car at age 74, so she bought 9 cars in my illustration here. That means that she took out $423,000 from her account. Once again, how much did she put in? She put in $12,000 a year for 7 years. Her capital investment was $84,000. That's what she put in. Look at how much she withdrew to buy vehicles, $423,000. So it's already a winner just on that end. Because if you think about buying cars the traditional way, you don't end up with $423,000, right? That money's gone. Well, however, she's not gonna have that problem. She's still gonna be making interest on $1,938,000. Can you see how expensive opportunity cost is? You don't think that financing that car at 4.9% actually is gonna cost you $2 million, but it will, because you gotta add the compounding and you gotta earn the interest that you're not earning. And she has liquidity, 100% tax-free, by the way, of almost 1.2 million. So her 84,000 went into her own bank. All she did was take a car loan, pay back, take a car loan, pay back, and she ends up with an asset making her interest of almost $2 million. Pretty powerful, right? So it doesn't matter your age, it doesn't matter anything, it's a financial positioning. That's what banking is. Let me close with this point, because I get this question a lot, and if you guys come out with a lot of questions, I'm happy to answer. The question that I get is, Django, come on, time out. This can't be for free. What's the gotcha? Where is the problem? This can't be for free. Of course, it's not free. There's not such a thing as a free lunch. Everything costs money. So I would like you to get your attention now on this column right here, the loan balance column. Do you see this $800,000? That's how much she borrowed plus interest from the life insurance company. Do I care about that amount? No. Why? Because it's going to get deducted from my death benefit when I die. I will never pay that in my lifetime. She has a $2.8 million death benefit. We deduct these $795. Her family still gets almost $2 million, 100% tax-free. So I don't care. It's like a mortgage, guys. When you buy a house and your house is growing in value every year, do you care about how much the bank is making? Well, you shouldn't, in case you are, because you're making more. So I don't really care what the bank is doing, because I'm making money. I'm getting a tax deduction on my mortgage, and my property is going up in value, hopefully. So I'm fine, even though I borrow from the bank to buy that property. It's exactly the same concept, but instead of using an actual bank, we're using a life insurance company because it's more efficient, it's less expensive, and it allows the money to multiply itself and do the things that I just showed you. Okay, let's wrap it up. So now she's 78, right here, and we do have $1.2 million that we have in liquid assets. So why don't we pay her supplemental retirement income, let's say $50,000 a year, And let's say that she passes away at age 93. Why age 93? No reason. I just picked that. It could be age 120. It doesn't matter. It will be the same amount. Okay. So if she passes away at age 93, we pay her all this tax-free additional retirement income. Again, banking is not a retirement plan, but we do have the money. So why don't we use it? Look at this. At age 93, she's still making interest on $3,418,000. Pretty sweet, right? So once again, how much did she put in? She put in $84,000. She took out $432,000 to buy vehicles and then pay it back with interest to herself. And she's still making interest on almost $3.5 million. She still has $831,000 in cash. And when she dies at age 93, her family still gets almost $1.2 million, 100% tax-free. So let's summarize this. She put in $84,000. She took out $423,000 to buy vehicles, and the amount of wealth that we were able to generate by closing the opportunity cost gap and by preventing the wealth transfer to other financial institutions, she ended up creating $4.5 million of wealth. And by the way, that's just one car. Think about it. What about if they finance her car on her husband's car? That will be twice the amount. What about if they finance those two cars, plus their children's wedding, plus the college education, and so on and so on and so on? Do you see how that interest compounded over time starts to stack up? The numbers become almost hard to believe. It almost sounds too good to be true. And that's some of the feedback that we get. But it's not too good to be true. It's just the math. If you can capture the majority of the dollars that you earn, and you can put them to work for you towards the future, as long as you're alive, while at the same time, you use somebody else's money to buy the things you need, you will end up with a large amount. It's just basic math. But most people don't have the means to do so. So that's why we partner with an insurance company to be able to set this kind of system up for your benefit. And obviously, we can go over the details of that at some other time. I'm running out of time. So 6:15, we promise you it wasn't going to be more than 45 minutes. This is the banking concept with numbers, conceptually. Any questions, anything on the chat, Sharadi, that we should address before we wrap it up tonight?
Nope, we don't have any questions. I did want to point out that if anyone does want to come and, if they have their own specific situations that they want to talk about, go ahead and reach out to us. Do you want to go ahead and give your contact information, Janko?
Yes, so you can reach me at 714-881-9982. Let me put that on the chat for everybody. So if you guys have a question, you can give me a call. I'm going to put my email in the chat box as well. It's janko@qxfinancial.org. Do you want to put your email as well, Sharadi? Yeah, so you guys want to share an email? I know based on the list, I recognize some names. So I see some people already are working with some of our advisors. So you can reach out to your advisor. You can reach out to me. If some of the names that I don't recognize, if you're thinking about implementing a plan like this, talk to us first. Let us evaluate if it makes sense for you. We'll run the numbers for you and say, hey, this is why it does or it doesn't make sense. So at least you get an objective view of how this can potentially work for you. Today it's a real example, but it's just an example. All right, so there are no questions. So again, I know we have people here from the East Coast, so I want to let you go. Thank you so much for your time, guys. I hope this was useful. Let us know if you have any questions. Happy to work with you. You'll get a link with a survey. Please make sure to answer it. You may actually get a link also with a recording of the video. You want to watch it again of the webinar. We're here to help. Have a wonderful night. Thank you for your time.